Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
All right, welcome to the Prescribing Prosperity podcast with John and Alex Soutsos. Guys, this is a podcast today aimed primarily at Canadian investors, and I see that you've got a guest in to help you talk about this subject and maybe inform your investors or potential investors a little bit better.
This morning we have Ron Lokaisingh, who is a guest host, who's going to be acting as the everyday Canadian looking for information about what all these fancy terms mean in terms of investment accounts and distinguishing features of each. So we're going to let him run the show, and we'll just be here to answer the questions and have a conversation.
I appreciate you having me on, and hopefully we can clarify some of the alphabet soup of the financial industry terms that everybody has sometimes problems with. I know I have over the past years. I've been investing with you and on other investments for over 20 years, and every so often still have to come back and go, well, what does this term mean? And how does that relate to me and where I'm heading and what I'm doing? So I think this is a great opportunity for people to learn a lot of things and maybe even re-listen to the podcast from time to time to get some clarification based on where they are.
That's actually a great idea. I think this is going to be an evergreen show where people can refer to it as they wish.
Absolutely. I mean, we were just talking about, when certain things were introduced, for example, in Canada, when was the TFSA introduced, and was it still something that I should be looking at other than an RRSP, for example? But, why don't we start with that? I think the basic thing that most Canadians are looking at are RRSPs. And other than understanding what the letters stand for, what is an RRSP and why should someone consider that and maybe consider it as soon as possible?
Well, that's a great question. And really, it all begins with the process of financial planning. So when we first meet a client, the objective is to get a financial profile, and that involves identifying their income, their annual income, their employer, their tenure there, what their objectives are in terms of when they would like to reach retirement or semi-retirement age, and then identifying what their current assets are, what their current liabilities are, and then putting together a plan to create a system by which they will be investing on a monthly basis, plus utilizing what they've accumulated to date in order to get to that target. And there's various account forms that are utilized in order to have that money grow. And each one can be viewed as an umbrella from the umbrella providing some tax sheltering, and what is not under the umbrella is not going to be tax sheltered. So the RSP is the cornerstone of the tax sheltered accounts that are available to Canadians. And essentially, when you put money into an RRSP, which stands for Registered Retirement Savings Plan, the amount you put in can be deducted from your income. And when you deduct it from your income, you essentially will get a refund of the taxes you've paid when you file your tax return. So in essence, when you put in your after-tax dollars into the RSP, it allows you to recoup the remainder of the tax dollars, so your money is whole again. So you're back to 100 cent dollars, and now that money is being productively invested. An RRSP is not a specific investment. It's just the name of the account type. It's a tax shelter. It's an umbrella under which you can invest in many, many different things. You can invest in stocks, bonds, mutual funds, and potentially a few other things. But that is essentially it. It's an account with which you build your retirement, and you can continue contributing to a retirement savings plan or an RSP up until the age in which you the year in which you turn 71 by December 31st. At which point you must convert the plan to a registered retirement income fund and begin a minimum withdrawal process that starts the following year. And that's the fundamental essentials of an RRSP. Do you think we've covered that material sufficiently, or do you have some questions about that?
I think it's good, but one of the things that, let's just say I'm starting out, I'm a 20-year-old person who has just gotten a job. I'm not making a lot of money right now, and I guess that I think I'm in the bracket where I'm not paying a lot of taxes. Should I invest in an RRSP right at the start, or should I be investing in a TFSA, and maybe explain a little bit about the TFSAs, for example?
Yeah, that's a great question. I think when you look at it, when you're comparing, so before I answer that question, I'm just going to back up and just mention one thing, Ron. And when you look at investing, so if you look at your investment dollars as a stream, you basically have a point in which it diverts into the two different major types of accounts you can go to. One of them being registered accounts, and one of them being non-registered. And the only difference between the two is registered accounts in Canada have some sort of tax benefit. So an RRSP is an example, and is the primary and longest standing version of a registered account within Canada. We'll talk about non-registered afterwards. So once we get into the registered side, that's where you have your different account types, where RRSP being the primary one, tax-free savings account was the one that was introduced in the around 2009. And so with a tax-free savings account, what it does is it allows your money to grow on a tax-free basis. And that means, it's money that is added to your account on an after-tax basis, so there is no tax deduction, but the money is able to grow tax-free for as long as it's invested within the account. So for somebody, going back to your example, of somebody who's relatively young, isn't earning a lot of money, and therefore is in a relatively low income tax bracket, the savings that they're going to generate from an RRSP are probably going to be less than the savings they're going to get from a tax-free savings account, because of the fact that they're going to benefit from tax-free growth in their investments over an extended period of time. So if they're only, let's use the example of they're paying in the 15 to 20% income tax bracket. At 15 to 20%, they're still going to be less than if they're going to be taking out a large capital gain 30 years from now, when they're at a much higher income tax bracket, and they sell their investment. It's grown in value over that 30-year period. The marginal tax rate at that time is probably going to be closer to 54% for them. Capital gains are taxed at only half of your capital gain is included. So you're essentially only paying about 27% tax. So you're saving a much higher rate with the tax-free savings account than you would be on the RSP at the point in time in which you're not earning a lot of money. The other benefit of the RSP is the fact that you can go back and you don't lose your contribution room. If you don't use the contribution room when you're younger, you instead choose to allocate your money to the TFSA. Once you are starting to earn a little bit more money and you want to start to reduce your taxable income, you can go back and you can catch up essentially for the years in which you did not contribute to your RSP. So for the last 5 years, if you didn't contribute to your RSP, you can still go back and you can add the money that would have been accumulated, or the room that you would have had for each of those 5 years continues to build each year. And you can go back and you can catch that up in order to reduce your taxable income in a year in which you maybe have a higher income, and therefore you're going to have a higher tax bracket, or be in a higher tax bracket, and then you can lower that by deducting your contributions to the RSP.
So that's really interesting. I think one of the things that I understand from that, so Alex, as you're saying, if you're investing in the TFSA as you're younger in a very low tax bracket, you can then, let's say 10 years from now in the future, if you're making a lot more money, and let's say you're in the 35-40% tax bracket, anything that you have not contributed over the last 10 years into an RSP, you can then add those up and contribute that under the current tax liability. So now you're getting a taxable benefit based on that 30 or 35%.
Exactly.
That's fantastic.
So to provide some context to this conversation, let's take a look at what the tax rate is for Ontario residents. And the rates I'm about to give are not going to be too different from province to province, but obviously people, if they're not Ontario residents and they're listening to this, should be checking their own provincial combined federal provincial tax rates. But here in Ontario, on the first $49,231 of income, your marginal tax rate is 20%. When you move up to the tax bracket where you're earning between $86,698 and $98,463, which I think is going to capture a fair bit of the population, your marginal tax rate jumps from 20% up to 31.5%. And then when you go over 106,717 up to 150,000, now your marginal tax rate's at 43%. Over 235,675, your marginal tax rate is 53.5%. And there's a few other tax brackets in between those three that I mentioned, but it gives you some context as to what the impact is of tax savings for our RRSP. So if you're 25 years old, you're just starting out and your income is below $49,000, although there is a tax benefit to the RRSP, there isn't a significant tax benefit. The tax-free savings account is going to allow you to build up your savings without the benefit of a tax break. But oftentimes I find the younger people are using the tax-free savings account, not just to get started with their savings, but because they're trying to save up for a home purchase, although that's all changed recently with the new first-time home buyers plan. But usually in the early stages, that is the route that we advise. And the RRSP is something we suggest you start contributing once you build up to a higher tax bracket. That being said, it doesn't have to be either or. So you can have, let's say, for example, if we identify that you should be saving 20% of your income, we can help you decide what percentage of that should go into the RRSP, what percentage should go into the tax-free savings account, depending on what your objectives are. So the portion that's going to the tax-free savings account may be for an objective that is more current. The objective for the RSP is obviously for something that's more down the road.
Right. And I think, John or Alex, I think a lot of people look at all the different investment vehicles and it is very confusing. Should I, I'm in my 30s, I've just had a child, and people are talking about, is it RESPs now?
Correct.
Definitely, I'm not necessarily making maybe a lot more money, but I've had a lot more people to take care of. Now I'm a father, I'm a young father, but I want to start saving for my child's education. Do I invest in RESP and maybe cut back on some of my own RRSPs, or do I continue with the TFSA? I guess this is where your advice kind of comes into play. But in that simple scenario, what sort of advice would you give someone?
I'll jump in here quickly, and then Dad, you can comment as well. It depends really on a situation to situation basis. So it really depends on what how much extra cash flow you have and how much you can afford to dedicate to your child's educational savings plan. So the RESPs, as you mentioned, are the registered education savings plans that are available here within Canada. And basically what it does, it just allows you to contribute a certain amount of money each year and then be eligible to receive grant money from the government up to 20% of the first $2,500 that you invest on an annual basis. And so it allows you to accumulate $500 in grants, and the money grows within the account and is essentially tax-free until it's withdrawn in the hands of the beneficiary, which is oftentimes your child that you're creating the plan for. And so there are benefits to the RESP plan, but it is by no means the only way that you can accumulate money for a child. So if you're in a situation where, right now you may be relatively young, a young parent, and you don't have a lot of discretionary cash flow, and you may have other intermediate needs, and therefore you want to be able to allocate that money towards, maybe it's buying a house, for example. You think it's more important for you to save money towards buying a house so that way you and your young family can live comfortably somewhere. That's fine. You may lose out on a couple years of grant money in the interim, like the RSP. You can go back and you can do catch up. Unlike the RSP, where you can catch up many years all at once, in the RESPs, you can only catch up 2 years at a time. However, you can do that down the road when you have more discretionary cash flow. You can also utilize other account types that are essentially just by creating a trust, setting aside money for your children. It doesn't generate the grant money, but it has a little bit more flexibility with when the money is withdrawn, what it can be used towards, and the freedom with which it can be shared between siblings. So, Dad, is there anything you wanted to add on that?
Yes. So this is an important point. So on the RESPs, Registered Educational Savings Plans, the question we often get is, how much should I be putting into the RESP? And you can put in $50,000 maximum. An education, it depends on the type of education, obviously, you're looking at, and on a post-secondary basis. Today in Ontario, if you're going to into a program that is subsidized by the government, you're looking at tuition of roughly something in the range of $8,000-9,000, and if the program is not subsidized, maybe twice that. Then on top of that, you have, obviously, if you're living in residence, the cost of residency. So it can add up quite significantly. So how much do you put in? And how do you know how much you should be putting in when your child's just an infant? Well, first of all, not everyone attends post-secondary education, and that's not necessarily a bad thing. Certainly we have a lot of people in the last 2-3 generations that have achieved post-secondary designations, but we also need tradespeople, and we need other skill sets in society. And not everyone who is born into a family is destined to go into post-secondary education or into a program that's going to require a lot of money. So how much you put in is something that you're going to have to make a decision up front and say, okay, well, if they do go to post-secondary education and they're going to go attend a university that's going to cost, for the sake of discussion, $40,000, am I going to pay for the whole thing? Or do we get our child to work during the summer times and help subsidize their own education? And my experience indicates that it is best to get the child involved in paying for their education so that they appreciate what they are receiving. So if you're looking at a total cost, let's assume they live at home and they're only paying for the tuition. And let's say, for the sake of discussion, if we're using round numbers, that's $10,000 per year, or $40,000 over 4 years. Well, perhaps as a parent, after doing the calculation with the assistance of a professional advisor, what the future value of that is, and determine today, okay, we want to subsidize 50% of that cost. And then the other 50% will be taken on as a responsibility by the child as they attain an age where they can start working and help pay for their own way through. And I think that's a fair arrangement. When you say, as a parent, make the commitment that you're going to save 100% of the potential future cost of education, that's a huge burden on you. And you have your own retirement plan to pay for as well. So I think that is something parents need to consider, is the fact that not every child's going to attend post-secondary education. Therefore, you can utilize something called an in-trust plan, and you can have an informal trust account whereby you can put in money. There are no upfront tax savings. Whatever income is attributed to the investments of that trust will flow back to the beneficiary, which is the child. And when the child's a minor, obviously they're not going to pay any taxes on it. And the investment is likely going to be a capital gains earning instrument, which means that whatever income is generated is going to be minimal and taxes will be non-existent. So it's another great way of saving, and the child can accumulate that money, or the parent can accumulate that money for the child, at which point in the future can be used to start a business, to purchase a car. Something beyond education that is going to be required, or for the child that does not attend post-secondary education. So we need to consider that and provide some flexibility to the parents and grandparents. And that's another thing. You have parents, you have grandparents who are contributing potentially to education, and maybe parents want to take on the responsibility of contributing to the RESP. Grandparents potentially can fund a trust account to help with other potential expenses. So there's an idea as to how you can approach this problem.
So
The
there's
RESP,
multiple ways.
yeah. Sorry, Ron, just to jump in on the last point my dad made there. The RESP does come with very stringent rules regarding who can contribute, and when different people contribute, which child can access it. And I'm referring to a family RESP. So basically, it's a one account which you can designate multiple children within, and they can share the money that's in the that's been contributed to the account, up to certain rules and regulations regarding how much grant money they access. But anyway, I digress. The point being, there are a lot of rules that are applied to it, and only certain people can actually contribute to those types of accounts. And so as a result, it creates a little bit of logistical difficulty when you're trying to get multiple family members who want to contribute to a child's education, whether it's aunts and uncles or other people who want to give money so that child has money for their education. In the future, the RESP has limitations with regards to who can put the money in. Whereas when you have the trust, it's a much cleaner and simpler vehicle for allocating money towards a kid's future education.
So I think if somebody's considering an RESP, that's where a financial advisor or a portfolio manager comes into play, and you guys can give the advice that is needed based on the circumstances and what people are looking for. So we've talked about RRSPs, we've gone into TFSAs, we've talked a little bit about the RESP. Are there any other registered accounts that we talked to? I think, John, you had mentioned
The first home savings account.
Home savings account, yeah.
Alexander, it's a brand new savings feature that's just been introduced, and it's so new that not all institutions have set it up. But it does allow young people, or anyone, you don't have to be young, as long as you haven't purchased a home before, you can put money in up to what's the maximum, Alexander, now 20 or 30,000?
It's 40,000 for a lifetime. It's $8,000 per year. The first home savings account is a combination of the benefits of a TFSA and an RSP. Contributions to the first home savings account are tax deductible, and it's tax-free growth. So it takes the two major benefits of a TFSA and an RSP, it mashes them together, but it's only eligible for people who haven't purchased a home in the past, as you mentioned. So it was just launched in April of this year, of 2023. And you're able to contribute $8,000 per year up to a maximum of $40,000. Now, one thing that we did mention with the RSP and the TFSA is both of those can also be used as vehicles for withdrawing money for purchasing a home. So an RSP, for example, as a first-time home withdrawal plan or withdrawal allowance, you can basically take out a portion of your RRSP in order to contribute to a housing purchase. So in that instance, it's $35,000 that you can withdraw from your RSP tax-free, and then you can use that to purchase a home. Now, it comes with a little bit of restriction in that you have a 2-year grace period, after which you have to repay the loan over a 15-year period, if I'm not mistaken, to back to your RSP. So it's basically borrowing from your retirement in order to fund your home, your first home purchase. The TFSA can also be used for withdrawing money and using it for something such as a home purchase. That's often prior to the first home savings accounts creation. That's something that we recommended, and what I did personally for when I bought my home was we utilized the TFSA because it's a little bit easier. So you already have the tax-free withdrawal of the money coming out, but there's no restriction or requirement for you to recontribute that money back into the TFSA account. And so it provides a little bit more flexibility. If your circumstances change, you don't have to worry about paying back your home loan immediately. You can just focus on making your mortgage payments and maintaining your home, as opposed to repaying it back to your RSP. So going back to the first home savings account, it combines both of those into one simplified feature. And $40,000 is, and if you're living in the GTA, the Greater Toronto Area, you'll know that's not going to be enough on its own to buy a house, but it'll at least give you a sizable portion of your down payment potentially, and then you can utilize the other two account types to supplement your down payment and use that money to contribute towards a first home purchase.
I think that's something that was not well thought out by the legislators that came up with this new savings account, is that the cost of acquiring a home is very different from one part of the country to the other.
Yeah.
And there should have been some kind of consideration for that, either that or just have a much higher limit. Obviously, it doesn't matter what part of the country you're in, $40,000 is not going to cut it. You're going to need a lot more than that. And given that that is a large problem for most Canadians and the current younger generation, those people who are younger than 40 are having a seriously difficult time getting into the housing market, which is a problem that's partially been caused by policies of the recent past. And to introduce this new savings plan is wonderful, but it has to also be practical. And $40,000 as a limit is, I think, really falls short.
Yeah, I recently traveled across Canada, and I haven't found in any province I can buy a house for $160,000. So
yeah, exactly.
I'm not sure where you can put $40,000 down as a 25% deposit.
Yeah, I mean, if you want to say the average home price in Southern Ontario is, if I'm not mistaken, somewhere in the neighborhood of $1 million or just under $1 million. Even if a $500,000 home is $100,000 that you need in down payment, assuming you're putting 20% down. So it really is not a lot. So that's why I said it has to be contributed, or it needs to be supplemented with other investment accounts, and oftentimes that's going to come from your RRSP and your TFSA.
Anything else from a registered accounts that people should be thinking about, other than obviously what we've talked about, RRSPs, RESPs, FSHA, and the TFSA?
Well, something else that people may wish to consider are the locked-in retirement accounts. So sometimes people are working for employers that have a defined benefit pension plan or just a defined contribution pension plan. And I don't know, Ron, if you want to get into the nuances between those two different types of pension plans. But when you have a defined benefit pension plan and you leave your employer, you can transfer the accumulated pension benefit to your own RRSP, except it's designated as a locked-in RRSP. We use the acronym LIRA, Locked-in Retirement Account, as a short form to describe that, and that permits the money to continue growing in a tax-sheltered environment, but it is designated specifically for proceeds of a pension plan. You cannot contribute cash flow from your employment income to build that up. Furthermore, it depends also on whether that pension plan was federally or provincially incorporated. So if you end up working for a company that had a federally incorporated pension plan, that is one type of LIRA. And if you alternatively have worked for, or later on you work for a company that had their pension plan provincially incorporated, you're going to end up having two different LIRAs. They're both called LIRA. They're not distinguished in terms of the acronym or the type of account, but they're going to be separate account numbers simply because the sourcing of the retirement asset was incorporated differently, depending on the level of government.
And just, sorry, Dad, just to jump in, it could also be called something else. So LRSP or RLSP are examples of different types of locked-in retirement savings accounts. It's just the acronym can change depending on the jurisdiction. So from province to province, they sometimes have different acronyms. So just for people in different provinces, if they hear.
Just a clarification on what does locked in mean?
It means you cannot access the money prior to age 55. So after age 55, you can start withdrawing that money, but there is actually a formula that must be followed. And the formula is quite complex. And usually the custodian of the LIRA or of the locked-in retirement savings plan will provide that the range. There's a minimum and a maximum withdrawal rate, unlike an RRSP where there is no maximum. But when you make a withdrawal or a RIF where there's no maximum, there is a minimum on a RIF or registered retirement income fund. On a locked-in retirement account, which converts to an LRIF, or a locked-in fund, LIF. Here's where we go through the alphabet soup of account types. So there is a range. There's a minimum and a maximum. The maximum is usually determined by the yield on 10-year bonds in your province of jurisdiction. So it's a bit complex, but suffice it to say, Ron, what the government intended from the outset is that this is pension money. They don't want you pulling it out all in lump sum after age 55 and spending it all, because then that means the people are going to become more reliant on the government.
Right.
So essentially, they want to ensure that that money lasts for the remainder of their lifetime. And that's the distinguishing feature of a locked-in plan versus a regular RSP.
A distinction, again, further distinction would be, excuse me, if you have an RRSP, you can take money out, for example, to buy a home and then put it back over a period of time if it is dust, or you can actually even take money out and be maybe taxed significantly at that time. But with the locked in, you just can't touch it until 55.
No, you can't touch it. Now, it's interesting you brought that up about taking money out of the RRSP. Oftentimes, I shouldn't say often, but from time to time, people may run into financial difficulty, and they want to pay down some debt that they've accumulated with a financial institution. They will contact us and say, well, I want to take some money out of my RSP to pay down this debt I have. Now, it depends on the debt, obviously, but if unless it's a credit card where you're paying 28% interest, at which point it's not much different. But if you have a debt where the interest rate is lower, taking money out of an RSP, adding it to your income, and usually people who find themselves in this situation might be in a 40%, let's call it 40% marginal tax rate. You're going to pay 40% taxes to pay off a debt that has a 6% interest rate. It makes no sense. Wow. So it's something that people should think twice about before considering an RSP, even though it has some liquidity prior to retirement age. It's really not a great source for emergency funding. You're better off arranging to have a line of credit set up early on when you acquire a home, for those people who have acquired a home. And if you haven't acquired a home, you can have a line of credit that's unsecured. But that should be your first source of emergency credit, should you require emergency credit, other than your savings, of course, not an RSP. The RSP is designed for long-term wealth accumulation targeted specifically for your retirement.
Yeah. If you absolutely had to dip into your investment savings, the TFSA is a much more forgiving vehicle to utilize rather than the RSP.
Fantastic.
Yeah. Now, on the subject of TFSA, to carry the point further, when the TFSA was introduced, there's a lot of promotion that happened in the media by the major banks in Canada, and they promoted it as a short-term savings account. And that's what a lot of people did, is they put their short-term savings into the tax-free savings account, thinking this is what you do, where you put your short-term savings. But in fact, that's wrong. That's not the way a tax-free savings account should be utilized. That's not to say you can't access it in the short term. Obviously, you can. But the real reason the tax-free savings account was introduced by the government of the day was the original intent was to eliminate the capital gains taxes. And when the government of the day went to the bureaucrats and said, we want to eliminate capital gains taxes, they shook their head and they said, that is going to be extraordinarily complicated because we've had different inclusion rates for capital gains calculations over the course of time. And it's just going to create an immense amount of complexity. In addition to that, the hit to the Treasury in the short term is going to be quite significant. So as an alternative to eliminating capital gains taxes, the tax-free savings account was born, but it was designed by the government of the day to allow people to save into capital gains earning assets for long-term wealth creation without taxation. And therefore, the tax-free savings account is best utilized for that purpose. And if you're going to be tax sheltering your, back then, what was a 1% interest rate for short-term savings accounts, and even today it's 5%. If you're tax sheltering that is of minimal benefit. You want to tax shelter something like capital gains, where the rates of return are significantly higher potentially, and the numbers are going to be significantly higher when you withdraw money. And really, that's the purpose of the TFSAs, for long-term capital gains. You can use it for short-term requirements if necessary, but you should be thinking about it in terms of long-term, a long-term savings vehicle.
I think the TFSA, I really like that idea. But sometimes it's confusing when I look at savings account. I tend to think about bank accounts, but really, as you said, that's a vehicle, and you can put anything in it. So you can invest that money into stocks and bonds as well.
Yes, absolutely. A tax-free savings account is a perfect vehicle for investing in stocks. And we say stocks and bonds together because oftentimes you have a balanced portfolio that blends the two. But if you're going to be investing for long-term wealth accumulation, and you can handle some volatility, stocks obviously are the preferred vehicle in a professionally managed environment. Or you can invest in mutual funds, whether they're stock only or balanced, which means they're a blend of stocks and bonds. I really don't see the merit of investing in a bond fund within a tax-free savings account, since it has minimal growth potential. So you do want to lean more toward growth-oriented assets. And even for those people who want to speculate a little bit and they want to go into a more focused stock portfolio, for example, you may want to go into a software stock fund that can be quite volatile, but also can give you significant potential for capital gains in the future. That's the place to do it, is in a tax-free savings account.
ETFs are also eligible to be held within a tax-free savings account. And just further,
sorry, what's an ETF?
Sorry, that's a good question. An ETF is an exchange traded fund, so it is not actively managed in the same way that a mutual fund is, and so it therefore has a lower fee structure than a mutual fund would. So it's created to replicate either an index or a group of securities. So, for example, you can purchase an ETF that buys all of the healthcare stocks on a particular index, and it'll track the performance of each of those healthcare stocks exclusively, rather than having to buy the entire index. So let's say, for example, on the S&P 500, you can buy one of the Spider ETFs, or pick your provider that replicates the performance of all of the healthcare stocks on the S&P 500. Anything further to add, Dad?
What's a Spider?
Yeah. Other than the crawling thing.
SPDR.
Spider's the brand.
Yeah, it's the manufacturer of the exchange traded fund. It's S&P, the organization that creates the index. So yeah, there's different organizations that sponsor exchange traded funds, and that's the one Alexander mentioned is just one of them. There's many different companies here in Canada. We have a company called Horizons and the RBC, et cetera, different banks. So there's a bunch of them that are available, and that's where once again you need the guideline of a professional to help you do that. And in our case, in our practice, we actually have created portfolios, preset portfolios that do utilize exchange traded funds extensively to create a strategy, whether it's long-term 100% equity growth or one that is more moderate in its nature, 60% stocks, 40% bonds. So whether it's an exchange traded fund, individual stock holdings, actively managed portfolio of stocks, the tax-free savings account is a great tax sheltered environment within which these assets can grow over an extended time frame. And you should be looking at time frames of at least 3 years and ideally 5 years plus for these types of instruments.
The other thing that you can do is, if let's take the example of somebody who scores balanced, which whenever you join a financial management firm, you usually complete a questionnaire. It's called an investor profile questionnaire. Then the purpose of that is to determine your level of risk tolerance. Most people tend to score balanced, which is a composition of 60% equities and 40% bonds or fixed income. You can take the 60% of your total assets and concentrate those in the TFSA in order to benefit from the tax benefits of the TFSA account, and then focus the fixed income portion of your portfolio on in a different account. So you can utilize the RRSP, for example, rather than the TFSA for the fixed income portion of your portfolio.
And that is certainly a great strategy that Alexander mentioned. Sometimes, though, people psychologically get a little flustered because they might say during a review, why is my TFSA down so much and my non TFSA is not, why don't we move that over? And so it's important that point is explained, that the investor understands why the capital gains assets are in the tax shelter and the non-capital gain assets or the interest-bearing assets are in the non-sheltered account. So we see it together as a portfolio, but sometimes investors get confused by that. So it's important that is explained at the outset, so you don't run into that difficulty or that frustration.
Boy, I think we can spend probably another couple of hours talking about all the different things here. I'm sure you'll have other podcasts, but
yes,
I'm thinking maybe as in a summary, what advice would you give, say, I don't know, 20-year-old Ron who is just starting to invest, or maybe, 45, 50-year-old Ron who says, hey, I haven't done anything and I need to start investing. Is it similar? Is it different? What would you suggest?
Oh, it's going to be very different. I think essentially, I like to refer to the time frame after age 50 as the retirement red zone. And that is the 15 most, assuming you retire at 65. Now, no one says you have to retire at 65. And in fact, these days, very few people actually retire fully at 65. But it's a commonly accepted retirement date. It can be the date upon which you transition to semi-retirement, for example. But that age, 50 to 65, is the retirement red zone. And what that means is you got to maximize the growth of your capital. Traditionally, there was a rule of thumb that was used in the financial industry that said, well, when you're younger, you can afford to invest aggressively because if you lose money, it's not a big deal. You have a long time frame to wait for it to recover, and you can't do that when you're older. But in fact, the guidance I give is the opposite. Although it's great to make 20% on an account when you're 25, you're probably making 20% on $5,000, which is wonderful. But it's $1,000 profit. Whereas on $500,000, it's $100,000 profit. So it's important that in your retirement red zone time frame that you actually try and maximize your rate of return. So Ron at age 45 should be looking at, first of all, perhaps depending on how much has been accumulated up until that point, may have to make a material change in their standard of living. Maybe has to downsize prematurely. Maybe has to downsize from 2 cars to 1 car. Or may want to move to a place where they can use public transit. Some of these ideas obviously sound radical to people, but I do have an instance where I had a professional family, a medical doctor and his spouse, who lived in a large, beautiful home in Richmond Hill. And one Sunday afternoon, the husband says to his wife, after looking at his investment portfolio and retirement accounts, we're simply not going to have enough at the pace we're going right now with our lifestyle. We're not going to be able to save enough for our retirement. We got to do something different. And they made the tough decision to downsize their home out of a beautiful 5-bedroom home into a condo. And it was tough to do, but that's where I came into the picture, and I designed a plan for them to save systematically on an annual basis a certain amount. And of course, met with them annually and semi-annually to make sure they were on target. And many years later, when they got to age 70, they were able to retire with a comfort that they desired. We actually hit the financial target that we determined when they were 50. It sometimes requires some very painful decisions when you're 45 years old or 50 years old and you haven't saved enough. When you're 25 years old, the guidance is save 20% of your money because you're going to need it in the future. And I think Alexander sees this with his peer group. He's not 25, but he's closer to 25 than I am. Alexander, do you want to elaborate a little bit on the mindset of the people around your age?
Yeah, I think it's just a lot of times people have the mindset where they discount the future as, it's a long way away. I don't need to worry about that right now. I've got a lot of time to play with. And what ends up happening is they opt for immediate gratification, whether that's utilizing money for discretionary purchases such as consumable goods, travel, what have you. And not to say that those things are not important and that you shouldn't be allocating some of your cash flow to those things, and you should enjoy your life in the present. But at the same time, there needs to be a balance, and there needs to be consideration for the future requirements that you're going to need in retirement. When you get to retirement, a lot of people are not generating employment income anymore. They're whatever age it tends to be. We've talked about the fact that 65 is not a frequent retirement age, but at some point, generally people get to a stage in life where they're no longer able to work. And so you need to rely on your accumulated investment income in order to sustain yourself during that period. And a lot of people my age, I've noticed, they tend to opt for the immediacy of having something now rather than setting that money aside for the future. So I think it's important that people understand that there's only so much time that you have that the money is going to accumulate and grow, and there's the compounding effect that also allows that money to grow. The longer it's invested, the more money you're going to end up with in the future. Even if you're only setting aside a little bit now, 10% is better than 0%. And I think a lot of people get stuck in the mindset of, well, I can't save 20, I can't afford that, so I may as well do 0. Well, that's not true. You should look at what you can afford to set aside. As my dad said, maybe adjust your lifestyle so you can get closer to that 20% threshold that you should be setting aside. And once you're in a more established position, then maybe you go past 20% in order to catch up. But you need to still be thinking about the long-term benefits and needs that you're going to have when you're in retirement.
Something that is very critical for savers to understand is there's 3 factors to wealth creation. You have amount of money, rate of return, and time. And of these 3 factors, most people believe rate of return is the most important, when in fact, it is actually time. Alexander alluded to the concept of compounding. Compound interest is considered one of the wonders of the world.
Magic.
It was well, I forget who said it, but they said it was the 8th wonder of the world. It may have been one of the Rothschilds or somebody else, I don't remember, but maybe it was even Sir Winston Churchill who said it was the 8th wonder of the world. But somebody said it was the 8th wonder of the world, and it's very important to understand that compounding your capital over an extended time frame is what builds wealth. Rate of return obviously is important. Amount of money is obviously important, but when you do the math, time is the most critical element, and this is why it's important to start young. With your first job, start to save. And as Alexander said, it doesn't matter if you can't do 20 or 25% up front, 5%, 10%, just get into the habit of saving. When you create your standard of living early on in your life after starting your life, you need to look at what lifestyle you're looking for. And then you budget backwards and say, what can 80% of my cash flow buy me in terms of lifestyle, in terms of house, and in terms of car? And then that's how you're going to decide how much house and car you're going to get, which are the 2 biggest expenses. And if you start on that basis of budgeting your expenditures first on after calculating 80% of your take-home pay, then you're going to be far better off. And 20% sounds like a huge number, but think about this for a second. When I began my career, one of my peers, David Chilton, wrote a book called The Wealthy Barber, and it's a wonderful book. And if people haven't acquired it, there's actually an updated version of it. The Wealthy Barber is based on the concept of saving 10% of your income and investing for the future. And 10% is a decent starting point, but 10% based on the rates of return that we've achieved in the financial industry in the last 10 years, or what's widely available in the financial industry, is not going to cut it. So if you can, you want to build on that number and try and get it up as much as possible. Just on a quick note, the Ontario Teachers Pension Plan, arguably one of the best pension plans in the world, they force teachers to save roughly 13% of their pay. The employer then matches it, so they're up around 25%. And even at that, they only cover 2/3 of your best 5 years when you retire. So starting early is critical.
Do you remember when we were younger, Dad? When you sat down, my brother and I were, I don't know how old we would have been. I might have been 10, he might have been 8. and you gave us the example of compounding. Do you remember doing
I
that?
don't remember doing that, but sounds like something I would have
Sounds like
done.
John.
So he sat us down and he gave us he gave us two choices. He said, one of you can start saving $250 now until you're, I think it was 65 that he used the number, and then one of you can wait 10 years and then start saving $500. And he randomly assigned, he said, Alexander, you're going to take the $500, but you start 10 years later. And the at the end of the exercise, you know, he calculated out and he goes, look, this is how much money you're going to have. And my brother had significantly more than me, even though I'd saved at a higher rate for, you know, an extended period of time. The fact that he started sooner allowed that money to compound over that 10-year period in which I wasn't saving anything. And the benefit was that he was further ahead than I was at the end of the exercise. And I was really upset. It pissed me off that I got the worst portfolio, but I think he did it intentionally because it stuck with me more. That lesson really hit me, and it was embedded in my mind that, you know, that was something that was important to set aside money right from the very beginning. You know, I remember working at my first employer, CI Investments, and they gave us the opportunity to, I think it was, we could contribute up to 5%, and they would match up to 5% of our income. And I remember looking at it as, well, if they're going to give me an extra, it's essentially an extra 5% bump on my pay.
Yeah.
Now I'm not getting it right now, but I'm going to get it in the future. Why would I not take advantage of that? That's, instead of getting paid whatever it was, $40,000 when I started, it was an extra 5% on top of that. So an extra $2,000. So anyway, it's an important lesson to remember.
You know, back then you were talking about savings and how much money you can, and depending on your lifestyle. I knew this gentleman, and he was a multimillionaire, and he goes, I can't afford a Ferrari. And I said, what do you mean you can't? He goes, nope. He goes, based on how I save and the lifestyle that I want, there's no way I can afford a Ferrari in my driveway. And I went, that's interesting. And he's a multimillionaire.
Smart.
So,
yeah. How much you earn doesn't matter as much as how much you save. So you can have someone who earns $1 million a year, and if they save nothing at the end of 10 years, they have nothing. Exactly. Whereas if you earn $100,000 a year per year and you save 20%, then at the end of 10 years, you have 20,000 times your rate of return times compounding, and it's going to be something more than nothing. Yeah. So that's exactly a good point. I'm glad I actually did something right as a parent. I don't recall that story, so I'm glad I actually did that.
They were few and far between, so they're more present in my mind.
I'm sure he can recall a few lessons.
I know you guys have talked. We've talked a lot about registered accounts. Is there anything else you want to talk about? I mean, I know there's other things as non-registered accounts, but I don't know if we have time for just introduction on that or not.
Yeah, we can just do a quick summary. And essentially, a non-registered account is basically any type of account that doesn't have any taxable benefit associated with it. We basically treat it as an overflow, so you should be maximizing your contributions to your registered accounts first, because obviously they carry with them tax benefits that, as an investor, you'll want to take advantage of. But the non-registered accounts also have benefits in that they can be utilized within a corporation. So a lot of our clients tend to be doctors or medical professionals or business owners. And so when they have a professional account, they have assets that sit within that corporation. Rather than leaving that money in basically what's just a cash account at the bank, a checking account at the bank, you can actually grow that money on your behalf. And so that way the business can still benefit from capital appreciation over an extended period of time, just like you would want your retirement account to have. And so you can invest corporate assets within a non-registered account. That's the only account type that you can utilize. The other benefit of a non-registered account is the ability to utilize margin. I don't know if you want to touch on that, Dad, or if we want to leave that as a subject for another day, but margin is another benefit of a non-registered account.
Yeah, I think we're coming to the end of today's program. Just very quickly, yes, non-registered accounts are where you can invest money that perhaps you come into on a lump sum basis, whether it's the sale of a business, an inheritance, somewhere where you can invest money that it did not emanate originally from your cash flow from employment income. And we can get into more details about distinguishing between a cash account and a margin account on a future episode.
Okay. Well, thank you very much. I think we've used almost all of the letters in the alphabet. We still have a few left, but I'm sure there's many more things that we can chat about later. Thank you, John, Alex, very much for inviting me on your podcast. And Bill, I'll hand it over to you.
Yeah, Ron, no, thank you. I really appreciate your voice in this one. And John and Alex, this is a lot of information for listeners to process. And they want to get in touch with you. They got further questions. How do they reach out to you? How do they get a hold of you to get some answers?
Yeah, absolutely. So they can reach out to us. We have a website. It's medwealth.ca, medwealth.ca, or johnsoutsos.com. You can look up either one of us online on LinkedIn at John Soutsos or Alexander Soutsos. We also have a company page. It's MedWealth Financial Services on LinkedIn. You can email us, info@medwealth.ca, if you have any questions, or if you want to set up a free portfolio analysis, or just to schedule a meeting to ask some questions and get a little bit more understanding about where you are in your journey towards retirement.
Thank you very, very much. It's a lot of stuff to process. Again, if you've got questions, you know how to reach out to John and Alex to get the answers. And to our listeners, thank you very much for listening to this podcast. If you're a new listener and you like what you heard, you need to be sure to hit that subscribe button below so that the next episode will be automatically delivered to you and you won't miss an episode. We also humbly ask that you share and rate the podcast, because by doing that, you will help others find it. I'm Bill Tucker, and on behalf of John and Alex Soutsos, thank you again for listening.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.